Have you ever watched a child on a swing? Back and forth, higher and higher until they reach the top, slowing down and swing back the other way. That's exactly how the Stochastic Oscillator, or SO, works. It measures where price is within its recent range, so you can tell when the market is swinging too high or too low and might be ready to change direction. As they reach the highest point and reverse, fade into a chart where price moves up and down while a stochastic line oscillates between 0 and 100 below. The SO is a momentum indicator created by George Lane in the 1950s. He believed that momentum changed before price does. So, by reading the stochastic, you can often spot when the trend is losing steam before the candles actually reverse. Technically, the stochastic compares the current closing price to the range, the highest high and lowest low, over a certain number of periods, usually 14. It then scales the value between 0 and 100. Here's how to interpret it. When the stochastic is above 80, the market is overbought. Price is near the top of its range and buyers might be getting exhausted. When it's below 20, the market is oversold. Price is near the bottom and sellers might be losing strength. Think of it like a battery. When it's fully charged above 80, it can't change much more. It will likely start draining soon. When it's almost empty below 20, it's due for a recharge. Now, the stochastic isn't just one line. It actually has two. The percentage K line, which is the fast moving one, usually shown as blue. The percentage D line, which is a smooth version of the percentage K, often red. When the percentage K line crosses above the percentage D line, it's a bullish signal. Momentum might be turning upwards. When it crosses below, it's a bearish signal. Momentum might be fading. Here is a practical example. Imagine EUR/USD has been falling for days. The stochastic drops under 20, showing oversold conditions. Then percentage K crosses above percentage D, and both starts moving up. That's an early hint buyers might be stepping in. A few candles later, price starts rising. Now, flip the scenario. Price has been climbing fast. Stochastic rises above 80, and then percentage K crosses below percentage D. That's a warning that the rally might be losing momentum. Show opposite setup. Price uptrend, stochastic over 80, bearish crossover, price pulling back. The stochastic is all about speed. It reacts quickly to price changes, which means it's great for short-term traders. But it also means it can give a false signals during strong trends. When the market is trending hard, it can stay overbought or oversold. Think of it like sprinting. Just because someone's running fast doesn't mean they will stop immediately. They will slow down eventually, but you don't want to stand in front of them too early. That's why professionals use stochastic together with support and resistance trend lines or other indicators like RSI or moving average for confirmations. For example, if price is at strong support zone and the stochastic is oversold with a bullish crossover, that's a higher probability buy setup. If price hits resistance and stochastic is overbought with a bearish crossover, that's strong sell signal. There is also something called divergence, which is a very powerful signal. If price makes a lower low but the stochastic makes a higher low, that's a bullish divergence. Momentum is shifting upward even though price hasn't yet. If price makes a higher high but stochastic makes a lower high, that's a bearish divergence. Momentum is fading. This is often the earliest clue that a reversal could be near, like hearing thunder before seeing the lightning. Let's also talk about the settings. The default setup 1433 works well for most traders. The first number, 14, is the look back period. The second 3 smooths the percentage K line. The third 3 smooths the percentage D line. If you shorten these numbers, the stochastic becomes faster but noisier. If you lengthen them, it becomes lower but more reliable. Here is a simple method many traders use. The first one, identify the trend using a moving average. The second, wait for stochastic to reach extreme levels, above 20 or below 20. The third, look for crossover in the direction of the trend. And fourth, use support or resistance for timing your entry. This combination filters out the bad signals and keeps you trading with momentum, not against it. So let's recap what you just learned. The stochastic oscillator measures momentum by comparing the closing price to its recent range. Above 80 equals overbought. Below 20 equals oversold. The crossover between percentage K and percentage D gives buy-sell clues. Divergence warns of potential reversals. Works best when combined with structure and trend confirmation. In simple words, the stochastic doesn't predict the future. It tells you when the market swing is reaching its limits. It's like watching that kid on the swing. You know they'll come back down eventually. You just need to wait for the right moment to push. So in short, the stochastic oscillator helps you see when the market's momentum is lowing, so you can prepare for next move before everyone else does.